Days after the market punished its stock for spending too aggressively, one company turned around and did something almost nobody expected. It doubled down harder. Taiwan Semiconductor Manufacturing Company just committed an additional $100 billion to its operations in Arizona, pushing its total investment in that single American state to $265 billion. To put that number in perspective, it is larger than the entire annual economic output of most countries on Earth, committed by a single company to a single state for a single strategic purpose. This announcement arrived in the same stretch of days when investors were nervously selling shares over concerns about rising capital spending, the exact same behavior now being repeated at an even larger scale. Either the market badly misjudged this company's judgment, or the company is making one of the most consequential long-term bets in the history of modern manufacturing, one that will not fully reveal whether it was right for years, possibly decades. Understanding why a company would make a bet this large, this expensive, and this unlikely to pay off quickly reveals something essential about the difference between how markets think and how empire builders actually think. The scale here deserves a moment of genuine appreciation before diving into the reasoning behind it, because numbers this large tend to lose their meaning through sheer repetition in financial media. The original commitment, announced roughly a year and a half earlier, was already the largest single foreign direct investment in the history of the United States, a staggering $165 billion devoted to building advanced chip fabrication plants, packaging facilities, and a dedicated research center. This new pledge does not simply add to that figure. It expands the entire footprint to 10 fabrication plants, 2 advanced packaging facilities, and a research and development hub, all concentrated in what was, until relatively recently, primarily known as a desert landscape rather than the epicenter of global semiconductor manufacturing. Few companies on Earth possess the balance sheet, the confidence, or the multi-decade time horizon required to make a commitment of this magnitude to a single geographic location, which is precisely what makes examining the reasoning behind it so instructive for anyone trying to understand how truly long-term capital allocation actually works.
What makes this decision especially striking is that the company's own leadership openly acknowledged the immediate financial cost of making it. Building advanced fabrication facilities in the United States costs between 4 and 5 times more than building the exact same facilities in Taiwan, according to the company's own chief financial officer. And that cost disadvantage is expected to widen, not shrink, as the scale of American operations continues growing. This is a remarkable admission for any public company to make, essentially announcing to shareholders that a core strategic initiative will actively compress profit margins for an extended period, with no promise of a specific date when that dilution will end. Most companies spend enormous effort convincing investors that every dollar spent will generate an attractive, near-term return. This company instead chose transparency over reassurance, openly trading a measurable, quantifiable cost today for something considerably harder to put a precise number on: resilience, positioning, and insulation against a risk that has nothing to do with quarterly earnings at all. That risk becomes clear once the geography of the global chip industry is properly understood. For decades, the most advanced semiconductor manufacturing on the planet has been concentrated overwhelmingly in a single, relatively small geographic area, a concentration that made enormous sense from a pure efficiency standpoint, but created a single, glaring point of vulnerability for the entire global technology economy. Nearly every advanced chip powering modern smartphones, data centers, and increasingly artificial intelligence systems traced back to production facilities sitting within a region facing significant, well-documented geopolitical tension. A disruption in that single region, whether from natural disaster, political conflict, or military escalation, would not simply inconvenience one company. It would threaten to stall an enormous share of global technology production almost overnight. Building an entirely separate, redundant manufacturing base on American soil is not primarily a bet on lower costs or operational efficiency. It is closer to an enormous, expensive insurance policy, purchased years before any specific disaster occurs, precisely because insurance purchased after a crisis begins is either unavailable or arrives far too late to matter.
Distinguishing between a temporary surge in demand and a genuine multi-decade structural shift is one of the hardest judgments any capital allocator ever has to make, and the stakes involved here could barely be higher. The company's chief financial officer specifically described the demand driving this expansion as a multi-year megatrend, deliberate language chosen to separate this commitment from an ordinary response to a short-term uptick in orders. History offers plenty of painful examples of companies that mistook a temporary boom for a permanent shift, building capacity that sat underutilized for years once demand normalized. It also offers examples of companies that correctly identified genuine structural change early and built decisively ahead of it, capturing decades of advantage precisely because they committed capital before their competitors felt confident enough to do the same. Nobody, including the company's own leadership, can know with certainty which category this decision will eventually fall into. What can be observed is the conviction behind the bet, backed not by a single quarter of enthusiasm, but by a revenue growth forecast raised to above 40% for the year and a track record of 5 consecutive quarters of record profit. This decision did not happen in a purely private corporate vacuum, and understanding the surrounding political context matters just as much as understanding the balance sheet. The expanded commitment followed directly after a new trade agreement between the United States and Taiwan that reduced tariffs, alongside vocal, explicit support from the American federal government, state officials, and regional economic development authorities, all of whom have clear incentives to encourage exactly this kind of onshoring. Modern industrial policy increasingly treats semiconductor manufacturing capacity not merely as a business decision, but as a matter of national economic security, worthy of direct government coordination and support. This represents a meaningful shift in how advanced manufacturing gets built in the 21st century, less a story of a single company chasing efficient markets wherever they lead, and more a story of governments and corporations jointly engineering where the physical infrastructure of the future gets constructed, driven as much by strategic necessity as by pure economic logic.
There is an unmistakable tension sitting at the heart of this entire story, one that echoes a pattern showing up again and again across modern markets. The difference between how quickly investors expect returns and how long it actually takes to build something durable. Days earlier, a stock sold off on fears about rising spending eating into near-term profitability. Now the same company is asking the market to absorb an even larger, more expensive, more margin-compressing commitment, betting that shareholders capable of thinking in decades rather than quarters will eventually be rewarded for tolerating years of reduced efficiency. This is precisely the kind of decision that looks indefensible on a single earnings spreadsheet and only makes sense when evaluated against a much longer timeline, one measured in the position a company and a country occupy within a critical global industry 10 or 20 years from now, rather than the shape of next quarter's profit margin. History has generally been kinder to the builders who tolerated this discomfort than to the ones who optimized purely for whatever made the next earnings call look best. None of this comes without genuine risk, and a fair account of this story cannot simply celebrate ambition without acknowledging the real possibility of overbuilding. This company is not the only one making enormous capital commitments based on the assumption that demand for advanced computing power will keep accelerating for years. Numerous companies across the technology industry are simultaneously investing staggering sums into similar infrastructure, all betting on the same underlying trend continuing at a similar pace. If artificial intelligence adoption slows meaningfully before this capacity comes fully online, or if efficiency improvements in chip design reduce the raw computing power actually required to deliver the same results, the industry as a whole could find itself with significantly more manufacturing capacity than the market actually needs, a scenario that would pressure prices and margins across every company that built ahead of demand rather than in careful step with it. Confidence expressed today is not proof of an outcome that has not yet arrived. An honest analysis has to hold both possibilities, transformative success and painful overcapacity, as genuinely live outcomes, rather than pretending the first is guaranteed.
History offers a useful, if imperfect, parallel from an earlier era of infrastructure building. In the 19th century, railroad companies raised and spent enormous sums constructing rail lines across vast stretches of undeveloped land, betting that demand for transportation would eventually justify the enormous upfront cost. Some of those companies overextended themselves badly, collapsing into bankruptcy when demand failed to materialize as quickly as projected, or when competition among too many similarly ambitious builders compressed returns for everyone involved. And yet, the railroads themselves, once built, became genuinely transformative infrastructure that reshaped commerce, migration, and economic development for generations, even in cases where the specific companies that financed the original construction did not survive to enjoy the benefits. This distinction matters enormously for anyone evaluating a bet of this size today. A technology or piece of infrastructure can prove genuinely transformative for society and the broader economy, even in scenarios where the specific company financing its earliest, most expensive phase does not capture proportional rewards for having built it first. There is also a broader, less obvious consequence worth considering, one that extends well beyond this single company's balance sheet. As onshoring and geographical diversification become standard strategic practice across the technology industry, not just for this company, but increasingly across an entire sector responding to the same geopolitical concerns, the cost structure underlying modern electronics may be undergoing a quiet, semi-permanent shift. Manufacturing in politically stable, higher-cost regions instead of concentrated, lower-cost ones tends to embed what might be called a resilience premium into the eventual price of finished products, a cost paid not because production became less efficient in a vacuum, but because an entire industry collectively decided that resilience against catastrophic disruption was worth paying for in advance. This is a different kind of inflationary pressure than the kind driven by energy shocks or loose monetary policy discussed elsewhere in recent headlines. It is inflation born from strategic caution itself, a reminder that the pursuit of safety at a global industrial scale is rarely free.
For an individual investor trying to make sense of an enormous capital spending announcement like this one, without either dismissing it reflexively or getting swept up in its scale, a few grounded questions matter more than the headline figure itself. Is the spending being funded primarily from genuine operating cash flow generated by an already profitable business, or is it dependent on heavy borrowing that increases financial fragility if demand disappoints? Does the company's management have a credible, demonstrated history of translating large capital commitments into durable competitive advantage, rather than simply a track record of ambitious announcements? And critically, is the margin compression being accepted bounded and temporary, with some visible path back toward improved efficiency as scale increases, or open-ended and indefinite? A company answering these questions well deserves the benefit of the doubt that comes with a demonstrated record of disciplined execution. A company answering them poorly deserves exactly the skepticism the market briefly and perhaps correctly expressed just days before this latest announcement arrived.
There is an old, unglamorous distinction that becomes unusually clear when a single company is willing to commit $250 billion to a single strategic bet: the difference between spending money and investing it. Spending consumes resources for something that provides value once, in the present. Investing sacrifices resources today, specifically because the decision maker believes the resulting asset will keep generating value for years, ideally decades, into the future, long after the initial discomfort of the expenditure has been forgotten. Markets, driven by participants who often measure success in quarters rather than decades, are frequently poor judges of which category a given decision actually belongs to in the moment it is made. History tends to be a far better judge, though it renders its verdict slowly, often only after the original decision makers have moved on entirely. Whether this particular $250 billion bet on American soil becomes remembered as visionary or overextended will not be settled this year or even this decade. It will be settled the way nearly everything of genuine consequence in the world of capital eventually is: quietly, patiently, and only in hindsight.